For more on the markets, let's bring in Brenda Vingiello, Chief Investment Officer at Hill Global Advisors. A couple of things have been happening that have got us concerned, Brenda, but I'm looking at the notes you gave to our people. You've got like 10 things that make you very sanguine. Even though the market's up so much, you think that the combination of the Fed going back to neutral, or i.e. lowering rates, along with GDP continuing to grow, along with things like AI and weight loss drugs in industrial spending, all that bodes well for continued moves and higher?
I do think so, although I think you need to look, if you look at just the broad S&P 500, for example, I don't think there's as much upside. Certainly, we've had a huge move. We think there's about 5 to 7% left. But if you look down at the individual stock level or in small and mid-cap stocks where valuation is much more reasonable, we still think there's a lot more opportunity. But I will say that, yes, I do think that we are still in a very positive environment. Obviously, there are risks. We certainly are reminded of the geopolitical risks out there more recently. But I do think that if we look at the big picture in the United States, the economy is still growing nicely, much faster than anybody thought that it would. And we have these big, huge thematic growth stories going on, and multiple growth stories, which is rare. And I think that is in combination with the Fed lowering interest rates. So I do think it's still a very supportive environment for continued appreciation of the equity market. But I will also say that the other piece that's happening now with rates coming down is that bonds have finally started to deliver a positive return. During the third quarter, bonds were almost up as much as the S&P 500, which is encouraging. But I do think that also serves as a really nice buffer for investors during moments like this, when there's volatile times, when there's a flight to safety. I think bonds have now resumed their historical role in terms of one of being not only a protector during volatility, but also one of really an asset class that can add value and return to portfolios.
That's interesting. So it's not a zero-sum game where money comes out of the stock market to go in the bond market. A lot of times bonds and stocks, when they're moving in tandem, that can be a positive. Do you think that the amount of money on the sidelines makes you feel better about valuations? I mean, 22 times, that's rich. But when I say that to people, they go, well, there's still a lot of money on the sidelines. But does it make you uncomfortable? That does seem to be a place where further advances are going to be more hard-earned, it seems like.
I agree. And I think coming into earnings, that's going to be important. So we need to really understand are earnings next year too low? If that's the case, then there's an argument for further appreciation. But I think, again, if you look at other areas like small and mid-cap, which are both trading around 16 times forward earnings, much more attractively valued. Also, if you take a look kind of below the surface, X out the Magnificent Seven, there are definitely opportunities within other sectors, and we've seen a nice broadening of market participation over the last quarter or so, and I think that is likely to continue. So I think if you look from a big picture perspective, yes, 22 times is expected, but there are other opportunities.